DBS, OCBC and UOB have been hitting record highs over and over again, and they are now up by as much as 35% this year, or closer to 40% once you include the dividends. So why do the bank stocks keep going up? And more importantly, is it too late to buy in now? Let's find out in this video. Okay, to understand why the bank stocks have been whatting big now, you first need to understand how a bank makes money. For many years, Singapore banks made most of their money from lending out money to borrowers. This is also known as net interest margin, or the gap between what a bank earns on its loans versus what it pays on your deposits. You can see this relationship clearly on the chart. When the US federal funds rate goes up, the bank's net interest margins go up, and when it goes down, the margins go down as well. So simple. However, here's the strange part. Even though the federal funds rate has been going down over the last couple of years, the bank's revenues haven't really dropped at all. If anything, they have been continuing going up. So, why? The main reason is that the banks have built up a whole second income stream outside of just making loans. Take DBS for example. Back in 2006, DBS was earning just 13% of its non-interest income from fund and wealth management. Today, that has grown to 34%. This is the same for OCBC, which have grown their fund and wealth management portion over the years, from 10% to 26% now. Meanwhile, UOB has been a little slow on that part. One big reason all this is happening is the rise in wealth management fees. Thanks to Singapore becoming the go-to base for the CBA ultra-rich and their family offices, the bank's wealth management fees have taken off. For example, DBS wealth fees have gone from just $1.8 billion in 2021 to close to $3 billion in 2025. And this isn't going to stop anytime soon. DBS is aiming to double its wealth management fees again by 2027 to around $4 billion, as more of Asia's rich move their money into Singapore. Besides the fees, this meteoric rise in share price is also supported by the bank's latest capital return plans. Back in early 2025, after making record profits through the high-rate years, all three banks have found themselves sitting on far more capital than they needed. So instead of keeping all that money for themselves, they decided to hand a big chunk of it back to shareholders through share buybacks and special dividends. For example, DBS is doing a $3 billion buyback plus that 15 cents quarter capital return dividend all the way till 2027. OCBC is returning $2.5 billion while UOB is giving out 50 cents special dividend on top of up to $2 billion in buybacks spread over 3 years. This is an especially welcome move given that the income that we can now get from SSB, T-bills and fixed deposits have gone down all the way to just 1.5%. Because of that, a bank that's paying you around 3 to 4% in dividends would look extremely attractive. Now, if you want to start investing, you need to keep your costs low. That's why I use Interactive Brokers. With Interactive Brokers, you are paying just 35 cents per trade on the US stock market. That's one of the lowest in the industry. They also give you access to Ireland domiciled ETFs, which can save you a chunk of dividend withholding taxes. And if you are not sure what to invest in, they also have a bunch of free company research tools built right into the platform, so you can do your homework before putting your hard-earned money in. Check out my link in the description to get started. Alright, now back to the video. But that raises another question. Given that the banks have gone up so much, surely they would be expensive now, right? If you value the banks using the traditional way, aka via the price-to-book ratio, all three banks' valuations are now at the 100th percentile, which means they are now at the most expensive level than they've ever been. But there's a catch. Since a large part of their income now comes from fees instead of lending, price-to-book has become a weaker way to value them. That's because the PB ratio only looks at the book value, and that book is now doing less of the earning than it used to. According to Aswaf Damodaran, the Dean of Valuation, a much better way to value a modern bank is by its earning power, or its return on equity. So if you plot each bank's price-to-book against its return on equity, you will see this. All three banks are now trading at roughly a 23 to 33% premium. While this is still quite expensive, it is nowhere near the bubble territory that people think the banks are at. And the analysts seem to agree with this. If we check analysts' price targets, all three banks are currently trading above where analysts think they should be. For example, DBS is trading at around $69, but the average analyst only thinks it's worth about $63. That's above 10% above target. And it is the same story for the other two, with OCBC and UOB both sitting at about 9% above where the analysts value them. But even though all three are trading above the target, analysts still rate DBS and OCBC a buy. UOB is the only hold, and that's because its earnings have been the weakest of the three, dragged down by those extra provisions. So what this tells us is that the banks are genuinely expensive right now, which brings us to the next question. How much higher can they actually go from here? If we plot a Fibonacci extension on DBS, you can see that it's sitting right at its first resistance now, at around $70. And it's the same story for the other two. OCBC is sitting right at its resistance around $27 and UOB at around $43. Though right now, the one warning sign that's flashing red is the RSI. RSI is a gauge which shows how overheated a recent run is, and anything above 70 would be considered as overbought and is due for a pullback. For example, you can see that back in early 2026, DBS RSI level went past the overbought levels a few times, and each time it did so, it saw some pullback. And right now, it has gone past the overbought level once again. However, just because a stock is overbought doesn't mean that it's going to jibaboom and crash tomorrow. Look at DBS back in May. Even though it has shot way past that level, it just be like meh and kept climbing. It was only a few weeks later, once the hype cooled down, that DBS finally pulled back. And even then, it carried right on up again after. As for how much higher it goes from here, here are a few things that are still working in the bank's favor. For one, the worst of the rate cuts looks done. SORA has already bottomed near 1% and is expected to tick back up a little by year end. So the margin squeeze that's been dragging on the banks should ease off instead of getting worse. On top of that, the bank's capital return programs, all those buybacks and special dividends, act as another layer of support under the share price. So every dollar of buyback is literally demand for the stock. And the wealth management engine is still expanding fast. Remember, DBS alone is aiming to double its wealth fees by 2027. That's a growth driver that barely depends on interest rates at all. That said, the banks are trading at a pretty stretched valuations right now, so a lot of that good news is already baked into the price. Personally, I would be a little cautious of entering right now. The chart is flashing overbought and all three are already trading above what the analysts think they are worth. And the dividend that you'll be buying in at is a lot thinner than it was just a few months ago. If you were to buy in today, you'll be taking on more risk for less reward than the people who got in earlier. But at the same time, if I'm owning the shares right now, I wouldn't be rushing to sell either. Nothing about the actual story has broken. The wealth fees are growing, the buybacks are supporting the share price, and the dividends are still very generous. Selling a solid business just because the price looks rich is how you will end up missing out on all the potential gains. So don't chase up here, but don't sell either just because it is expensive, because expensive can stay expensive for a long time. And I will just wait for a pullback to add. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every week.